Well, it was publicized and disclosed. I think it was last week that we had responded to the SEC's request for information around our Bitcoin filing, and we responded. And that's basically all we can say. I think many people think the fact that the SEC chose to ask questions is a change in behavior. And therefore, I do think hopes are rising that a number of Bitcoin ETFs will be approved.
The imminent approval of ARK Invest's Bitcoin ETF has ignited a wave of enthusiasm and speculation within the cryptocurrency community and the broader investment world. There's a palpable sense that there's a 90% chance of Bitcoin experiencing a substantial price surge by January 10, 2024, given that this is the deadline for ARK Invest's Bitcoin ETF application. This deadline has become a focal point, with many watching it closely, as it represents a potential gateway to the mainstream adoption of Bitcoin and other cryptocurrencies. A notable sign of impending approval is the recent engagement between the SEC and ARK Invest. In the past, the SEC has often outright denied ETF applications, but this time, it's different. The interactions between the two parties have resulted in updates to the application, which suggests constructive dialogue and a higher likelihood of approval. This pattern of engagement typically occurs when a fund is on the path to approval, raising expectations for the cryptocurrency community. Cathie Wood, the CEO of ARK Invest, has added to the anticipation by revealing that the SEC approached their team, leading to updates in the application. Her optimism is evident in her hopes for multiple ETF approvals occurring simultaneously. This optimistic sentiment reflects the evolving landscape of cryptocurrency investment. The anticipation of the Bitcoin ETF approval speaks volumes about the growing interest and acceptance of cryptocurrencies, and many investors eagerly await the outcome of this significant milestone. The cryptocurrency market is a dynamic space where developments can unfold rapidly, and this event is poised to be a defining moment for the future of digital assets.
Right, and I do believe maybe the reason they're saying by the end of the year, early next year, I know our final deadline on this filing is January 10th. And so, and I think we're first in line, but as you say, a number of Bitcoin ETFs could be approved at the same time. Well, I think there are a couple of things going on. If you'll remember, in late 20 and early 21, the flows were enormous into our funds, and I was uncomfortable at the time because we thought there was a lot of momentum chasing going on, and we said at that time, keep some powder dry. Little did we know how big the correction would be. This is sort of the flip side of that. We're feeling much more comfortable right now, but we did have, through July, a very significant rally. I do think there's been some profit taking there. And I do think, as you say, interest rates, rising rates have concerned a lot of people. There's been a shift into cash, and we've seen very recently a shift into bonds. And interestingly, the flows into bonds would suggest that we should not be far behind, because if bonds are going to rally, and we think they will at some point here, as inflation continues to come down, as the economy continues to go through rolling recessions of sorts, we think that the backdrop will be right for a resurgence in growth stocks generally, and in particular, long duration innovation growth assets like ours. If we're paying attention to company earnings, and some of these are companies we're exposed to, others not, you'll see at both the high end and the low end of the consumer spectrum in terms of price points. You've got Domino's saying, hey, it's really weak out there, we've got to do more promotional activity. And you've got LVMH, same thing. Both of those happened last week. We're paying attention to company reports, and I understand the economic statistics are volatile and showing strength and then weakness. We're paying attention to our companies, and it does seem like the consumer is starting to give way here. We see Nvidia, you might say it is less expensive than Tesla. We think the upside surprises on Tesla during the next 5 years, and remember we have a 5-year investment time horizon, are going to be substantially more than Nvidia's, mostly because most analysts do not believe that autonomous as a taxi platform for Tesla is going to be a part of the story. We disagree. And with that, we see incredible revenue and margin expansion. Nvidia's margins are already quite high, having entered the 70s, the gross margins. Tesla's are in the 20s, and we think they will scale into the 60s and 70s as autonomous takes off. So Tesla, we believe, is the biggest AI project, or autonomous driving is the biggest AI project in the world. Nvidia has been critical to providing the infrastructure to enable this and so many other things to happen. All praises to Nvidia. We think that a lot of people understand how important Nvidia is in this ecosystem, and they do not understand how much each dollar of hardware spent is going to pull software through. We think it's on the order of 20 times. So we think Nvidia is going to be a good stock. We think the stocks in our portfolio, and we've written a paper on artificial intelligence. It's titled "Investing in Artificial Intelligence: Where Will Equity Values Surface?" You can read that on ARK-funds.com and see how we're a really good diversification into this AI world. Many think that the winners are going to be the megatech companies who have had such strong performance over the years. We are not sure. We are not sure. ChatGPT could be the best thing that ever happened to Google, and that it lit a fire under Google to get its own AI into the market more profoundly. Or it could be the worst thing, in that it's going to lose its advertising franchise if we're all just on ChatGPT looking for our answers. Our confidence, if anything, has increased because of what's happening with artificial intelligence. Finally, ChatGPT captured the imagination of the investor. We had been talking about artificial intelligence since the firm started in 2014. And we had been very focused on Nvidia as the pure play in this space. So we were there when Nvidia was 5. We're on to the next thing now. And I would say you're picking early 21. The drop from early 21 in our strategies to the low was worse than the tech and telecom bust, which makes no sense. Back then, the technologies weren't ready, and the costs were too high. We didn't have the cloud, we didn't have deep learning and AI, we didn't have transformer technology. We were not ready for prime time, and the costs were prohibitive. Today, and yet, investors were chasing the dream back then, and that ended badly. Today, talk about investor psychology, we're ready for prime time. The dream is no longer, it's a reality. And investors are so fearful. And so we think that the surprise element out there, as our companies take off, and harnessing these new platforms, the element of surprise is going to be significant, and we will earn our way back into portfolios. There are many who stuck with us and averaged down all the way. We think they will be rewarded handsomely if our research is correct. We think it is correct. Of course, we could always be wrong. Sure, most of the stocks in our portfolios are there because we've used an AI lens. Now, we wrote a paper called Investing in Artificial Intelligence: Where Will Equity Values Surface? It's on ARK-funds.com. Now, I think many people feel comfortable. They're on the right horses, the mega cap tech companies, or the Magnificent Seven, one of which is Tesla. So we clearly agree with that one. We are not sure when it comes to the others. We think that AI is going to be highly disruptive, is going to disintermediate some of these platforms, not all of them, and that it may be the worst thing that has happened to a company like Google. Google If I can go to ChatGPT and just get an answer right away and not be bothered with links and advertisements, I might do that. Well, guess what? Google is responding and now giving me answers. So it could be the best thing that happened to Google. We don't know. All I know is that when there are major changes in platforms, especially user interfaces, now that we're thinking about glasses and other wearables, the winners of the last round in technology typically are not the winners in the next round. So we're on guard in that regard. And we know that most large cap portfolio managers own all of these. Our portfolios are a highly diversified way to participate in artificial intelligence. For every dollar in hardware that companies spend on artificial intelligence, it will probably pull $20 through in software. So that's why you see a company like UiPath, Robotics Process Automation, which we think is harnessing the foundation models that OpenAI, Anthropic, and others, Meta's Llama 2, it's harnessing those foundation models, but is using specialized models with its proprietary data to become the robotics process automation company in the world, the largest. And same with Twilio. What kind of data? And you'll hear four variables that we think are critically important as all companies approach AI and try and figure out, how can I harness the productivity gains from this new technology? One is they have deep domain expertise. They obviously know what they're doing, and they have a vision about where their own technology and company is going in the future. They have artificial intelligence expertise. They're taking this seriously. They have good distribution, preferably global, not always. And then most important beyond that, they have proprietary data. And most of the companies you'll see in our portfolios have proprietary data that no one else has that they can use to help their customers. Twilio is another example, 1 trillion business consumer interactions every year and growing at an accelerated rate. They can help marketers and salespeople understand, hey, these were the interactions that caused movement towards your company or your product. That is very valuable information that nobody else has.
With January 10th looming closer, the anticipation within the cryptocurrency community is palpable. Cathie Wood's involvement in this context adds a considerable weight of significance to this situation. The world of digital currencies is known for its dynamic and ever-evolving nature, and this moment reflects its fluidity. Regardless of whether you are a seasoned investor with a wealth of crypto experience, or a newcomer just dipping your toes into this exciting space, it remains essential to stay well informed. The digital currency realm operates in a state of constant flux, and as January 10th approaches, the crypto community finds itself on the cusp of potential groundbreaking developments. Given Cathie Wood's presence, the cryptocurrency world could be on the brink of transformative changes, which magnifies the importance of staying updated. For both seasoned investors, well-versed in the nuances of cryptocurrency, and newcomers seeking to navigate this evolving landscape, being well-informed is a critical aspect of successful participation. As we count down to January 10th, the crypto world buzzes with anticipation. The presence of Cathie Wood only adds to the significance of this impending event. The dynamic and ever-changing nature of the cryptocurrency space is well known, making it essential for both experienced investors and those new to the scene to remain vigilant and informed. This upcoming moment holds the potential for a paradigm shift, emphasizing the importance of keeping abreast of the latest developments and insights. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.